Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, LLC, member SIPC. My co-host tonight is Richard Sichel, who's the Chief Investment Officer of Philadelphia Trust Company. And our special guest is James Chan, PhD, and he is involved and owner of the Asia Marketing and Managing Company. And so we're going to find out something about Asia. It's going to be a great show. Stick with us. Okay, Richard, good to see you. How you been?
Nice to see you, Charlie.
Good. I want to remind our viewers and listeners that this show is taped, and they don't want to be doing any market timing based on what we're telling them. We aren't attorneys. We're not accountants. We're trying to give people some good investment advice, but they should also check with their own financial advisor before they make any moves. Okay, well, now that we've cleared that up, I want to talk a little bit about the differences between mutual funds and separately managed accounts and exchange traded funds today. So why don't you take the parts of those that you're most interested in and describe what goes on with whichever of those you want to talk about.
Sure. Yeah, I think we're a little bit unique. Everybody thinks they are, but we really just do separately managed accounts, which means individual stocks, individual bonds. We don't use mutual funds. We don't have them. We don't use others. And we just feel as though you know what fee you're paying with us. With mutual funds and such, it's a little more difficult to know. And from our standpoint, we think it's more tax efficient also to have individual stocks and individual bonds. So a client comes in, we work from a model of about 40, 45 stocks, and we're always adjusting, looking for new names or names to move off. But we will typically manage the portfolios that way for clients. And if we think you should have 3% in Kraft, a large client might have 15,000 shares of Kraft for 3%, a small client might have 100 shares of Kraft.
Okay, and one of the advantages of the separately managed account is that if other people are panicking, mutual fund managers can get caught in a situation where they want to do some buying, they know the market's cheap, but if some of their clients are panicking and still wanting to sell, they have to kick themselves doing liquidations, correct?
But we didn't rehearse this, Charlie, because I was talking about this lunchtime today. And basically the way we look at it, and it's unfortunate, if stocks are running high, everybody wants to get in, and maybe it's not the time to get in. As if you're a mutual fund manager, money's pouring in, you have to invest that money. You can't have money just sitting idle, so you're buying high. And when things go down, again, sometimes people panic and say, get me out. The mutual fund manager probably does not want to be selling at that point, but he needs to take care of those redemptions to pay the cash out to the people. So they're conflicted and maybe not always doing what they really would like to be doing.
So the manager of an account that you manage, an SMA, the individual owns those stocks outright, and they're not just pooled like they are in mutual funds, correct?
Correct. You see your statement and you see that you have 300 shares of CBS. I mean, those are your shares. You know what you have. It's easy in a taxable account as managers to say, okay, this client came in 5 years ago. They have this much gain. This client came in a year ago. We still might want to sell, but we will know what the gain is or maybe the loss, et cetera, and go from there. But it's very, very individualized that way.
And just to try to defend mutual funds for some people, my son and I have a business where we have a mix of some diversified managed accounts or separately managed accounts like you described, and some mutual funds sometimes, because some people can't afford to put all of the money in at once in order to have the pool of money you need to get established in an SMA. And as people build up their money, if they have a capital gain from a mutual fund, we can go over to the money manager and we can say, see if you can find any losses so we can manage taxes that way.
Right.
So mutual funds do have a place for some people.
Correct.
I also want to talk about exchange traded funds because I get questions from my clients quite a bit. An exchange traded fund is something you can buy and sell on the market at the time you want to make the purchase, where a mutual fund you have to wait until the close of business to make that purchase. So if someone thinks that gold is starting to go up because some event has happened at 10:15 in the morning, if they buy a gold mutual fund, they wouldn't get in until the end of that day.
Right.
And if they want to get in right at that moment, they could buy GLD or some, and I'm not recommending that investment. I'm just giving people an idea of what that's about so that it makes sense to them.
ETFs have come a long way. They're still relatively new in the investment world, and there's just an incredible amount of money in them. And they do give you that flexibility to move when you would like to move rather than waiting for the clock.
And so you can get into this philosophy of, is a index going to be better than a skillful manager can do for a client? And you can start talking about how you can outperform an index. When you buy an index, you know that you're going to get something like 99.7% return of what the market did if it's a good index. If it's not a good index, you might be very disappointed, but it'd be very unusual to make more than 100% because it's supposed to be mimicking the market.
Right.
And then the question comes up, can a money manager, a skillful stock market manager, outperform that index? And what do you say when a client asks you that?
You know, we get those questions, and you do hire a manager. You would like to beat the market. Maybe you're not going to beat it all the time, but over a period of time. And you know, since we came into business in 1999 until now, we have done much well in excess of the market, and that was based on doing a lot better when the market goes down, holding on to more of the money for when the market goes
What's
up.
called the capture ratio.
Right, or downside capture is
So
a good.
if the market,
you want a low number, or downside capture is low.
So if the market goes down 17% and your capture ratio is 80%, you would go down less than the market did, so there's more dollars to fight the next battle when the market goes up.
Right, so what you always hear about people are fighting back, and even the market's up, they're still coming back, where we have kept it closer, and we're not going to go up when the market's down. A couple of times we have, but we do. You know, so you're preserving more of the dollars, you're ready for when the market goes higher, and your dollars are there to work for you. Lately, it's been tougher for most managers to beat the market. We've been pretty close, but it's from point A to point B. Long-term investing, you know, we've done.
So we're not trying to tell our clients or anyone listening, our viewers and listeners, what to invest in. We just wanted to make sure they understood the differences and get some idea. And of course, they should check with their own financial advisor to get more detail. Well, let's talk a little bit about the world we live in. We're going to be talking about Asia in a few minutes here. The terrorism is scaring people. Do you see any choices in your selection of stocks that can benefit, because people are nervous now about investing all through the world? Are they better off in the U.S.? Are they better off allocating most of their money in the U.S.? What suggestions do you have for people that are nervous about investing and just want to put their money in money market because of terrorism and all the scary things going on in the world?
Sure. And I always look to this country, and we buy domestic companies. And it doesn't mean we don't look at the rest of the world, but we feel much better buying, say, a Procter & Gamble that gets 70% of the revenues overseas, but we're less than subject to sort of the vagaries of different countries, and there's less volatility that way, and we know and trust their accounting also. So that's one way to do it. And the other, obviously, is, again, this country, and with the political season, we can come up with all kinds of negatives that are going on, but this is still the best economy there is. U.S.-based companies are very, very productive, and earnings drive the stock market, and you look for companies with good earnings, and we try not to pay too much. It's called growth at a reasonable price, and that kept us away from, we missed some of the glamour way back of the dot-coms. But when they went down to nothing, we were all very glad that we stayed away from them because they had no earnings.
Sure, good. Well, just to give a couple of examples, and I'm not recommending these sectors, but I just want to explain to people how they can think about terrorism and how it could impact them. Perhaps cruise ships might be a good place to look if the prices are reasonable, because a lot of people now want to be on cruise ships where they know where they're going to pull in for a day or two, and they know they could stay on the ship if they wanted to, if the ship is stopping in a dangerous area, what have you. So cruises seem to be becoming more in demand. On the other hand, airline stocks, every time we have some horrible tragedy like that German Wings pilot pushing the nose over and flying into the ground, people get nervous about the airlines. And so there are certain segments that might be advantaged by all of the things that are going on in the world, and certain ones that might be disadvantaged. So it's a way that they can sort of think their way through and consult with their tax advisor
Right.
and decide how to take advantage or stay away from certain sectors.
And there's always Defense and Raytheon and L3 and companies like that that can do well.
Yeah, L3 is expert at the electronic stuff, and
Right.
that's come under a lot of interest since we've had people sending out emails that are supposed to have been kept quiet and all that. We won't get into the political arena today. Let's talk a little bit about gas prices. So the theory is that when energy is cheap, many companies benefit, and when energy is expensive, it's really tough on an economy. Is that the way you see it?
Yeah, I mean, that's how it has always been. And when oil was $140 a barrel a couple of years ago, it was tough. You go fill up whether it was an SUV or not, you were going to spend $60, $70, $80, $100 to fill up a tank. Where now it's come down so far, farther than we ever thought it would, and would hope that it would stabilize maybe in the $50 or $60 area. So consumers are saving a lot of money. Companies are saving money too, obviously, and airlines are saving money by having their costs lower. But up until now, there hasn't been much sort of an issue with the consumers saving so much money, they're not spending it.
Yeah.
And again, there's this number that every penny a gallon is $1 billion, either out of your pocket or back into the consuming public, which is 2/3 of the economy. We haven't really seen that spending. We would like to see it, but if consumers are feeling a little better and maybe paying a little credit card debt off or trying to save money, even though savers are getting beaten up every day with almost no interest,
Yeah.
it does help the consumer.
And my advice to clients is to assume that maybe oil prices will generally stay somewhere in the middle between those highs and lows, because the cure for low oil prices is low oil prices.
Exactly.
When everything is low, some people quit drilling for oil, et cetera, et cetera. The rigs get shut down, and then oil prices eventually work their way up. And when everything's going wonderfully well in the energy sector, then people are paying too much for their gas, and they cut back their driving, et cetera, and it drops the prices down. So I think the best way to assume, as you said, is the prices will be in the middle of the range they've been in for the last few years.
Yeah, that's definitely capitalism right there that you're talking about, and then we'll throw in some terrorism. There's always some premium for that.
Good. All right, let's see if we can help one of our listeners. Harry Rock of Exton says, what are some good investments in the international arena for the long-term investor?
And we did just talk about that we don't invest directly with international companies, but Procter & Gamble, Coca-Cola, Nike, Apple, they all get more than 50% of their revenues from overseas. Procter & Gamble and Coke happen to pay 3% dividends also, and they're increasing them, and they can afford to do that. So again, I would push more for investing internationally by way of U.S.-based companies. There are many, many great companies to choose from. I just named 4 of them, and there are more, but you can start to build a portfolio that way. You'll get the growth in the U.S., you'll get the growth in overseas. Not pure, but sometimes it's better not to. It's better to sort of smooth things.
And as discussed earlier, there are other alternatives such as exchange-traded funds, which might be an emerging market fund or international developed fund or what have you, or a small cap fund for people who want to put most of their money in safe blue chip stocks but want to do other things. And that's, again, consult with your financial advisor and make the moves. Okay, thanks for your help there, Richard.
Sure.
And if you have any questions, we're going to give you some information right now how to send them in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, now we want to welcome our special guest, James Chan, PhD, Asia Marketing and Managing Company. James, thanks for...
Thank you.
Okay, good to see you. Well, I guess the first thing people would like to hear is they hear all these headlines about how tough things are over in China and all that sort of thing, and you really keep your ear to the ground and you're plugged in well, you know what's going on. Are things as bad as we are hearing on television and radio these days?
In a nutshell, yes.
Okay.
I mean, I go to China, and every single day, especially in the morning, I call our agents and our customers. So everything they say in the media is real. Actually, the whole kind of financial economic slowdown began really in the latter half of 2014. So it wasn't really immediate because when I was there in the latter part of 2014, I already knew that some of our customers, which were mostly state-owned companies, Chinese government-owned companies, had to cut their own salaries. The workers' salaries had to be cut by 10%, and the managers and executive salaries had to be cut by 20%.
Wow.
So we started that early.
Sure.
And then over time, they're now encouraging people to retire early. Like if you work for a government-owned company, and there are about 150,000 of them, if you are men, you are encouraged to retire at age 60, not any older than 60. For women, 55. So it's real.
So that's
It's real.
to make a job available for a
For
younger
younger
person.
people, yeah, because
Okay.
there's so many people coming up and they need jobs.
Sure. Well, I only know what I read in the paper. I haven't been over to China lately, but you mentioned 2014. It seems that they wanted to the Chinese government wanted to get people out of the big cities, and they were Caterpillar made a lot of money over there because they were building cities away from the big cities, and they were allowed to charge a toll on a road for a certain number of years to get their money back and all this sort of thing. And so the problem was they were too early with all of this, and there are not see-through buildings, but see-through cities that I hear about. Is this true?
When you say see-through, you mean lots of empty apartments?
Lots of
Oh
empty
yeah, it is
apartments and-
absolutely
yeah.
true. In fact, there are moments people call those second-tier cities, third-tier cities,
Yes.
and indeed they are encouraged to build apartments and buildings and offices and malls but on the other hand, many people are doing it because they are a form of investment.
Yeah.
Because there's literally very little interest. If you have money, it's not very wise to put it in the bank.
Yeah.
And so it is true. Oh, before I forget, my latest trip to China in October, we were talking to a big state-owned company in the heavy machinery industry. And we heard of this young engineer in the company because there was so little work. I mean, everybody was, needing work. And he was so bored that he decided to take time off, not legally, to drive the Uber-type taxi.
Yeah.
Like in China, it's not Uber, it's called Didi Kuai Di. It's a form of,
Right.
kind of pseudo-taxi. Guess what? One of his customers was the CEO of his own company. And the poor man saw the CEO, and the
Did he
CEO...
lose 2 jobs?
Yeah, right. The CEO recognized him. So, what are you doing? He wasn't fired, but the end result was there were so many political sessions at the company. Everybody has to sit through training classes.
PC training.
Yeah, but that is a reflection of
Right.
how, like people are looking for work and finding
Yeah.
ways to make an extra dollar. I mean, extra
Sure.
yuan.
Sure. So they manage the results that they put out about how fast their economy is growing. They just dream up a number and say it's growing at 7%, or
Oh, right now they're more honest than that. They're
Oh.
saying that it's likely to be less than 6.1, maybe even less than 6. It depends, but you have to be realistic. From 1979 to 2012, for a long time, China grew at an annual rate of 9.9%. I mean, that's first of all, it just broke all records.
Yeah, we're
in
growing
human
at
history.
2%, and
Yeah.
we would love 3.
So 6% is really not that
Tremendous.
bad compared
Still
to.
very good.
I think its last quarter is 1.4 for us.
Sure.
Yeah.
Yeah, but it's always expectations versus what happens that
Right.
affects the market.
Right. China is changing every day, so changes are to be expected.
So if someone, manufacturing whatever here, they come to you and say, help? How do I sell these products in China? Is it that?
Yeah, I've been doing
That's
that.
the
I've
direct
been
question.
doing that since you came from New York. I started in New York working for a Fortune 500 publishing company. And I learned how to sell very high-level scientific, technical, medical books and journals. These were scholarly scientific monographs for university or PhD level or above people. And I succeeded in selling them, so I kind of developed an expertise in export marketing. So companies do come to me, and I always tell them that, China is a long-term market. One of my best clients, when they first saw me, luckily told me, James, we know that it's going to take some time to break into the Chinese market. We're willing to put in 15 years.
Wow.
Just to make sure that we are firmly established. It didn't take us 15 years to really penetrate the market, but it did take us 7. 7.
So
Okay.
people they need to have some sort of reasonable expectation that, hey, there's so many people there, here's our product. How
Right.
come everybody isn't
Right.
buying it today?
It's easier to make stuff in China and import them from China, because then you have control over the product. I mean, if the products are not up to par, you don't have to pay, and also it takes only 3 to 6 months for you to see results. But I'm not talking about importing. What I do is exporting.
Right.
So we
right.
have millions of farmers that are going to be leaving at some point, coming into these empty cities. We have all sorts of exciting things in the future. But over the next 5 or 10 years, where do you see the opportunities?
But the empty cities are real. It's real. But then China is very big.
Yes.
The empty cities do not necessarily make up all of China.
No.
In fact, for the farmers who used to go to the cities to work, now they're actually returning to their farms because they have the land, they can grow, they can raise animals, they have food, and they don't have to pay rent. That's their land. So in a way, I know for a fact, because I talk to people every day,
Sure.
that enough people don't even want to get jobs now if they are laid off, and many people are laid off. They just return to their farm and do the same thing that they did 10, 15, 20 years ago.
And these
But
are
in
growing pains is what all this is.
Oh,
I mean,
yeah.
So many people and growing so fast, obviously they couldn't continue at that pace.
In fact, the biggest complaint that all my friends and contacts in China tell me is that China has been changing so fast and daily. People don't have time to think. People really have no time to even sit down to think about the meaning of life or, what is good, what is bad. They just can't. It's like riding a tiger. You cannot dismount. It's psychologically very much like a pressure cooker. That's for everybody.
So in the United States in 1900, 50% of the people were farmers, and now it's 2%. And it's inevitable that they're going to be bigger and bigger operations to grow food. So this decision can be made for a few years or whatever, but taking the longer term view, where are the opportunities now? And if you were suggesting to someone who was living in China right now, what would you suggest that they try to do? What sectors are going to come open over the next decade, not the next 50 years?
Yeah. The answers are very clear because there was this 13th 5-year plan that was just being crafted, being produced. And the central government focuses on 4 areas in which they want to double economic growth by 2020. And the first of the 4 areas is agriculture. China needs food. It needs safe food. It needs, in fact, imported high-quality food. So that's one opportunity. The second is manufacturing. Manufacturing is still very important in China. It accounts for some 40% of the gross domestic product. And within manufacturing, medical devices, pharmaceutical industries, because China is aging. And there are so many people going through the aging process, and because of bad air pollution, water pollution, a lot of people are not really that healthy. So all kinds of medical inventions and innovation and creativity have to come together to help this generation of aging Chinese people. And the third one is entrepreneurship. Interestingly, they are promoting entrepreneurship, they're promoting innovation, and they want the Chinese to be more creative instead of just being obedient. And finally, research and development. Yep.
Okay.
Because China cannot continue to be offering the hands and the legs to do assembly work. It's no longer possible. Labor costs in China are rising at 10% per year for the last 10 years. So there is a school of thought that says China's advantage in terms of manufacturing, in terms of our outsourcing, if that's what you want, China is only 4% cheaper. 4% is not very much cheaper.
Not at all.
Yeah.
So the other countries around China are now having cheaper labor.
Correct. Vietnam and
Correct.
Thailand
Vietnam,
and
Thailand,
right.
Philippines,
Right.
Indonesia, Malaysia.
One other question, we're starting to run out of time, but I'm curious about the huge imbalance between the number of young babies, male and female.
Right.
And so when they're starting to search for marriage partners, what's happening with that?
That is tough. Even the Chinese government admits that it can be a problem because per 119 boys in China, there are only 104 girls. So they're predicting some 20 million men maturing and not having spouses. So it's
Unless they come
an
somewhere
issue.
else, some other
Unless they go
country.
do something else or leave China, I don't think it's possible.
Yeah.
So it's a perennial issue. And
Sure.
I don't have an answer because
No.
even China doesn't have an answer.
Well,
Are services difficult to sell, I guess, versus products?
Yes,
I
it
guess
is
like
going to
tech
be it's
services,
going to be more difficult, but
financial.
it's happening. Rich, it's happening because even though manufacturing is still important and it will still be important, but the service economy is growing, and right now it's confined to the restaurant and kind of home-related consumer level. But I think business services are going to be prospering, thriving over time, not immediately.
Right.
okay, well, we just have a minute and a half left or so. Why don't you tell us a little of your background and how you got interested in doing this?
Well, I was born in China, but I grew up in Hong Kong, and I came to America when I was about 20 years old. And I got my graduate school education, Chicago, for my master's degree, and my PhD from Ann Arbor, Michigan. And I used to be a professor at Boston University.
Oh.
And then I joined a Fortune 500 company, and I learned how to export. But in 1983, I decided to set up my consulting practice. And because of that, I wrote a book called Spare Room Tycoon, which has the stories of 40 men and women kind of having worked at big companies and big governments, and somehow they feel there is this inner voice to tell them to run their own businesses. And over the years, for helping American companies, I came up with this Secrets of Success in Business DVD, which is essentially to sum up my insights on how to sell effectively in the China market.
And people can find you on your website?
Oh yeah,
Okay.
it's on Amazon.com, all these places. It's easy to find.
Well, James Chan, we appreciate you coming on the show. We've scratched the surface of a huge topic, and we hope we can get you back here again.
Thank you,
So our
Charlie.
special guest next week is going to be Stephen A. Sweeb, and he's going to talk about retirement safety. So I'm sure it'll be a fascinating program. We hope you'll join us next week. As far as we're concerned, your money matters.